Bitcoin crashes to $66,000. Is this the first step towards zero? A veteran investor's structural analysis. If Bitcoin can drop to $66,000 this quickly, what exactly prevents it from eventually reaching zero? Not hope, not belief, not past performance. Only structure prevents zero, and structure is what most investors never examine. When Bitcoin falls sharply, the reaction is predictable. Retail investors panic, social media amplifies fear, headlines escalate drama. The narrative becomes binary. It's just a dip. It's going to zero. Both reactions are emotional shortcuts. Veteran investors do not begin with optimism or fear. We begin with mechanics. An asset does not go to zero because it declines in price. It goes to zero when liquidity evaporates, incentives collapse, access is cut off, confidence becomes structurally unrecoverable. Price is visible, structural decay is subtle. The market's greatest trick is convincing you that volatility equals death. It doesn't. Volatility is stress testing. Extinction is structural failure. At 66,000, the question is not, is this dramatic? The real question is, what layer of the system is deteriorating? If none are, then price is noise. When I evaluate whether an asset is heading toward irreversibility, I apply 4 structural tests. If these remain intact, zero is highly improbable. Layer 1. Liquidity infrastructure. Bitcoin's survival depends on functioning rails, exchanges operating globally, order books with depth, ETF vehicles trading, custody systems intact, fiat on-ramps accessible. If these collapse simultaneously, risk escalates. But at $66,000, major exchanges remain active. Institutional products still trade. Global access has not been severed. A falling price is not the same as a frozen system. Zero requires paralysis. We are not seeing paralysis. Bitcoin is not sustained by emotion. It is sustained by incentives. Miners secure the network because they are paid to do so. If mining becomes permanently unprofitable, hash rate collapses and security weakens beyond recovery, then the network enters fragility. But Bitcoin's design includes automatic difficulty adjustment. When weaker operators exit, the system recalibrates. It compresses. This elasticity is often ignored. An asset heading to zero shows signs of structural dysfunction. At $66,000, the incentive engine is under stress, not collapse. Stress is not extinction. Bitcoin is liquidity sensitive. When global monetary conditions tighten, risk assets decline, leverage contracts, speculation decreases. This is macro behavior. A price drop in a risk-on asset during liquidity contraction is not evidence of terminal decline. It is cyclical adjustment. For zero to be credible, we would need sustained institutional divestment, long-term capital abandonment, multi-quarter outflows with no replacement demand. Temporary de-risking is normal. Permanent abandonment is rare and visible. So far, this looks cyclical, not terminal. Bitcoin trades not just on code, but on thesis. Its core narratives include digital scarcity, alternative monetary system, hedge against monetary debasement, decentralized value transfer. For zero to occur, these narratives must be fundamentally disproven. Not emotionally questioned, fundamentally invalidated. Has the protocol failed? No. Has supply changed? No. Has global participation ceased? No. Sentiment has weakened, but sentiment fluctuates. Structural invalidation is different. Markets collapse when the story dies permanently. The story here is under stress, not disproven. 4. Silent pause. Zoom out. Step back. Detach from the hourly chart. Ask one question only. Is the organism failing, or is the organism adapting under stress? This distinction changes everything. Most investors never pause long enough to ask it. V. Where zero would actually begin. Let's be precise. Zero requires multiple failures at once. A realistic extinction path would involve coordinated global regulatory suffocation, mining incentive collapse, institutional capital exodus, infrastructure shutdown, sustained loss of transactional utility. This is not a one-candle event. It is a layered deterioration. And layered deterioration leaves fingerprints. Volume decay, hash rate collapse, custody withdrawals, exchange failures, institutional filings showing exits. Professionals watch these indicators. Amateurs watch the price ticker. The leverage illusion. Why many investors experience zero even if Bitcoin doesn't. Here is the brutal truth. Bitcoin may never go to zero, but leveraged investors frequently do. Every cycle follows the same pattern. Price rises, confidence expands, leverage increases. Minor drop triggers liquidations. Liquidations accelerate decline. This cascade feels like collapse, but it is mechanical. A 20% drop in spot is volatility. A 20% drop at 5 times leverage is obliteration. When people ask, is this the first step toward zero? Often they are really asking, is this the first step toward my forced liquidation? Markets don't need to go to zero to eliminate participants. They only need to exceed your risk tolerance. Zero is often personal, not systemic. Let's remove drama and build scenarios. Scenario 1, cyclical flush, most likely. Leverage resets, liquidity stabilizes, price consolidates, trend eventually resumes. Historically common. Scenario 2, extended sideways phase. Macro remains restrictive. Capital rotates. Sentiment cools. Painful for momentum traders. Structurally survivable. Scenario 3, deep bear market. Severe recession. Sustained institutional risk off. Multi-year stagnation. Not zero, but long winter. Scenario 4, structural breakdown. Low probability. Requires simultaneous failure of liquidity, incentives, access, narrative, institutional capital. Multiple systems must collapse together. Markets rarely implode without warning. Zero is not subtle, it is systemic. The irreversible insight. Survival is not about prediction. Here is the mindset shift that changes everything. You do not need to predict whether Bitcoin goes to zero. You need to structure your exposure so that if it does, you survive. That is professional thinking. No single asset should determine your financial survival. If Bitcoin thrives, you participate. If Bitcoin collapses, you endure. Markets reward durability, not conviction. End without CTA, the question that actually matters. Bitcoin at $66,000 is volatile. Volatility creates headlines, but headlines are not diagnosis. So ask calmly, is anything foundational deteriorating beyond repair? At this moment, infrastructure remains functional. Incentives remain intact. Liquidity exists. Access is global. Price is moving. Structure is not collapsing. The market does not punish volatility. It punishes fragility. The only real danger is not that Bitcoin goes to zero. The real danger is that your risk management does. Most investors think crashes begin with price. They don't. Crashes begin with liquidity contraction. Price is what you see. Liquidity is what you don't. When Bitcoin drops to $66,000, the surface narrative is simple: selling pressure. But underneath, the more important questions are: is spot liquidity thinning? Are derivatives funding rates compressing? Are market makers widening spreads? Is stablecoin supply contracting? Are ETF inflows reversing structurally? Zero does not start with a red candle. It starts when liquidity providers step away, because without liquidity, price discovery becomes violent, and violence destroys confidence. If liquidity remains elastic, meaning bids reappear when price drops, the system is functioning. At $66,000, volatility is visible, but is liquidity gone? Not yet. and until liquidity structurally evaporates, extinction remains theoretical. Retail reacts emotionally. Institutions move slowly but decisively. To evaluate real risk, watch quarterly ETF flows, corporate treasury allocations, fund disclosures, custody balances, derivatives open interest. Institutional capital does not vanish overnight. It leaks slowly. If you observe sustained multi-quarter capital exit without replacement demand, that is structural warning. But 1 week of panic, 1 month of drawdown, that is noise. The market often feels like collapse long before institutions truly retreat. Veteran investors don't react to fear. We track capital migration. If slow money remains engaged, zero becomes mathematically improbable. Let's confront the hardest question. Bitcoin cannot be shut down technically, but can it be economically suffocated? The only realistic zero scenario involves coordinated global suppression, severe capital restrictions, ban on exchange operations, institutional prohibition, banking isolation. But global coordination is rare. Financial systems are fragmented. When one jurisdiction restricts, another absorbs. History shows capital is opportunistic. Bitcoin survives not because it is unstoppable. It survives because global systems are imperfectly aligned. Total suffocation requires perfect coordination. That is structurally difficult. Possible? Yes. Probable? Low. And markets price probability, not imagination. The true death of an asset is not regulatory. It is psychological. If enough participants conclude this will never recover, demand collapses. But narratives die slowly. They decay when repeated structural failures occur. Promises are broken, utility declines, and adoption reverses. Bitcoin's core thesis remains intact: scarcity, permissionless access, decentralized validation. Sentiment weakens cyclically, but thesis invalidation is different. To reach zero, belief must permanently dissolve. That requires years of structural erosion, not one sharp decline. Let's shift perspective. When people ask, is this the first step toward zero? Often they are really asking, am I about to lose everything? This is not about Bitcoin. This is about exposure. Most retail investors over-allocate during euphoria. They increase position size near highs, use leverage, concentrate risk, and ignore liquidity conditions. Then when volatility hits, it feels existential. But markets don't go to zero to ruin portfolios. They only need to drop faster than your risk management can absorb. Zero for the asset is rare. Zero for the overexposed investor is common. This distinction is critical. Let's quantify calmly. From $66,000, we can assign rough probability buckets: cyclical correction and recovery, high probability; extended consolidation, moderate probability; deep, multi-year bear market, lower probability; structural extinction, very low probability. Zero requires liquidity freeze, incentive collapse, regulatory suffocation, institutional abandonment, and narrative death simultaneously. The joint probability of all five collapsing at once is small. Markets collapse when systems align negatively. Right now, systems are stressed, not aligned for extinction. Stress is part of growth cycles. Collapse requires convergence. We are not observing convergence. The greatest threat is not Bitcoin going to zero. It is investors mismanaging volatility. Volatility is the cost of participation. If you cannot tolerate drawdowns, you exit at the worst moment. You re-enter at the worst moment. You compound emotional losses. Professionals don't eliminate volatility. They structure around it: position sizing, diversification, liquidity reserves, survival first, return second. This is the doctrine amateurs ignore. Look at the chart. Now close it. Ask, is the infrastructure failing? Is the incentive engine collapsing? Is global access severed? Is institutional capital abandoning? If the answer to all four is no, then zero is not the base case. Emotion amplifies probability. Data compresses it. Here is the shift you cannot unlearn. Markets are not fragile because price falls. Markets are fragile when participants are overexposed. Bitcoin at $66,000 is volatility. Volatility reveals positioning. If the system survives stress, it strengthens. If your portfolio cannot survive stress, it was fragile. The danger is rarely systemic annihilation. The danger is personal overconfidence. Bitcoin may rise again. Bitcoin may fall further. It may trade sideways for years. But zero is not a headline event. It is a structural event. And structural events leave signals long before price prints zero. Right now, infrastructure functions, incentives adjust, liquidity exists, global access remains. The question is not whether Bitcoin will survive this drop. The question is whether your strategy will. Markets don't eliminate assets easily. They eliminate fragility. And fragility is rarely in the code. It is usually in the investor.